Right. Hello, everybody. Welcome. Happy Easter Monday. And if you are celebrating, well, I hope you get lots of chocolate. Even though, chocolates go on sale a week later, it's still not a good idea to get them. Okay, so happy Easter Monday and welcome to Money Matters. I am your host, Hung Lu. And so we're going to get going with a short analysis today because of the holiday Monday. So we will get going here. And today we're going to do an analysis on a new strategy that I'm checking out. It's not a new strategy in the sense of strategies. It's a new strategy for me because it's not one that I've done to this capacity. So I'm going to walk through some of the calculations with you on that. And so thank you to the attendees of the mastermind. Thank you for coming to the session last Friday. And we will be hosting our next session on the third Friday of every single month. So thank you for those who came because you gave me some additional ideas for this $100,000 to $1 million in assets. So I'm going to go through some of the calculations on that because I need to decide if I want to bring in a money partner or not. And so I'm going to go through that calculation and show you what my thought process is around, okay, should I bring in a money partner or not bring in a money partner? Because I've got some cash that I can deploy in this strategy. And so, it might not make sense to give up equity when I've got that cash. Okay, so this is Money Matters, and our whole goal with this is to help you make some sound decisions around your money so that you can grow your net worth and have time with your family as you see fit. And especially on Easter Monday, right? When would a message like that ever come through any quicker? So before you run off and implement this strategy as well, please just make sure it's right for you. I've got a different risk tolerance level. And so, what I'm doing to grow my family real estate portfolio, may be very different from yours. So check with somebody else. And if after today's analysis, if you're still feeling a little bit stuck with it, check out this link. Okay, you can sign up and join part of my analysis paralysis coaching program, and we go through every single calculation imaginable, and we talk through the pros and cons of all of it, like what we do here, but in greater detail and specific to your situation. Okay, so that is the spiel. Oh, let me share this because we do have a great event coming up. So if you are local to Vancouver, please check out this event. Sign up. We are doing a speed networking event coming up, and that's tomorrow evening. It is in downtown Vancouver. So if you're local, a great place to come and network. This is with fellow real estate investors. It is not really for newbies. I would say it's more for people because you have to pay to go. Right. And so usually for paid events, you sort of set the bar a little bit higher. So this is a low entry ticket point, okay, to come in. So if you are local, please come to the event and it'll be a great way to connect with fellow investors. All right, so now let's go into the calculation for today. So let me prep the situation here. So the idea with this 100K strategy to 1 million is to buy, I'm just going to make this a little bit bigger here, is to buy a bunch of properties. Okay, so single family specifically. So either townhouses or condos or single family. The condo would be the sort of like the last choice here, but the idea is to buy properties at 100,000. Okay. And if you've got the extra cash or if you got the scalability on that, you can go up to 200,000. The idea is to target the 100,000 range. Okay. And yes, there are properties in Canada that you could buy for 100,000 still. Okay. So let's just say we're going to proceed with the 100,000. So we're going to look at buying 10 of these units within a 30-minute radius. Okay, so you want to keep it local, keep it very tense. So most likely a secondary market. It's definitely not Toronto, not Vancouver, probably not Calgary or Edmonton. So like the primary markets, you're probably not going to do that. You're probably going to go into a secondary market. Like maybe Red Deer or in Ontario. So maybe like Cranbrook or outside of Peterborough, like so maybe 30 minutes outside of Peterborough, maybe. Okay, so that's going to give us our total value in the asset. So if we do 10 units, so you just basically take your 100,000 times your 10, that gives you your 1 million. And with all of these, because they're going to be investment properties, we're going to put down 20%. Okay, I'm going to run my numbers with 20%. So all the green cells are numbers that we can adjust. So we are probably going to put 25%, maybe 30% if needed. Okay, so we're going to run the numbers with 20%. So 20% down payment is 20,000. Because we're buying 10 units, our total down payment at the end of the day is going to be 200,000. So there's scalability here. Like you're not going to go out and buy all 10 in one shot. You're going to go out and buy one and then maybe buy another one, a month later and so forth like that, right? Okay, so the mortgage on this is 25 years. I'm running it with 25. I know some places are offering 30, but I want to run it with 25 to see how the numbers fall, and then we can always go back and adjust them. Okay, so I'm going to run this with the 1% rule. Basically, what it says is that any of the rents coming in, it's going to be equivalent to 1% of the purchase price. So I'm going to assume that, okay, we've already purchased all of these and it's going to be close to 1 million. So we're going to need to get about $120,000, okay, in total for the year. Okay, so this is for the year. And the way that works is because I'm going to just add this per year. Okay, so I basically just took the $1 million times the 1% times 12 because there's going to be 12 months. Okay, so now if I just went here and I change this to one, you're going to see that the numbers just adjust. So on one unit, I'm going to make $12,000 in that one year at 1%. Okay, so the target is to get 1% rental income. So I'm going to buy a townhouse, a condo, something like that, and I'm going to charge about $1,000 in rent. Okay, so if I can get that $1,000 per unit, then I've met that 1%. Okay, so just quick, easy, dirty math there. Okay, on that 1%. So now if I go here and I say, okay, on average, expenses are around 35%. Now, this is just like a number out of the sky. Okay, usually it's between 30 to 40% would be the range. Okay, for anything north of 40 is going to be a tough number. And basically, that's just taking my $12,000 for the year times 35%. Okay, so that's 4,200. So that means my NOI, my net operating income at the end of the year would be 7,800. Now, this looks really impressive, but keep in mind, I haven't taken out the mortgage yet. Okay, so we're only putting 20% down. So we have to go and take out a mortgage for the 80%. So the mortgage every single month is going to be $470 for that one unit. Okay. And this is just based on a 5% interest rate, 25 amortization years. Okay. And what else did we put it? Yeah, we assume that it's the 100, like whatever amount that we are able to acquire, less our down payment. So that's going to be what our mortgage is going to be. So this calculation does not include closing costs, and it doesn't include any of the, well, we got the expenses and the sort of any renovation money would be part of this 1%. So yeah, so the only thing that we have not included in this calculation is the closing cost. So just keep that in mind. Okay, so that means that after we pay our mortgage off of, let's see here, of $470 a month, which is equivalent to 5,600 a year. Okay, because we got to make sure that we're calculating on the same time scale here. So that means our cash flow at the end of the year is about $2,000. Okay, so as you can see, this isn't a huge big cash flow play here, right? So to get my cash flow calculation, I'm taking my 7,800 minus my 5,600. Okay, so just my NOI minus my mortgage, that gives me my cash flow. So the calculation I've done up until now, this is a standard calculation for every single property. Like it doesn't matter if it's single family, multifamily, or what sort of asset class within real estate. This is sort of like the basic calculation here that you would need to do all the way through anyways, okay? So $2,000 Okay, so let me just go over here and I'll calculate this here so then you could see whether or not this is a good number here. So $2,000 divided by 12. Okay, so that's roughly $182 a month in cash flow for that one unit. For a lot of people, that's actually a really good number. Okay, so it's not a bad number. Okay, so I'm gonna just say cash flow per month. Okay, so even though I'm saying this isn't a cash flow play, it could be a cash flow play because it's actually a decent number here. Okay, so I'm just gonna put that right over there. Okay, so this is your cash flow per year. Okay, so I'm actually just building this out because this is a new strategy that I'm looking at, seeing if it makes sense for me to do. Okay, so the interest. Okay, so now here's the big question. Is it better for me to bring in a money partner for the 20% down payment per unit? Or is it better for me to put out that 20,000 myself, pay 10% interest or, 13% or whatever interest amount that I have to pay in order to be able to get this cash? Okay, it's not free money. So potentially I could get it from my HELOC, or if I do private lending, then it would be, 10+% here. Okay, so if I was getting the private lending at 10%, let's say, then the interest that I would have to pay on this loan is $2,000. Okay, so that means by the time I pay off, so if I take my cash flow at the end of the year, this 2,200, and I take out my interest payments, then the net profit at the end of the year is just under 200. Okay, that is not a good number. Okay, so let me just go in here and I will move these cells around so that you could see what the effect is. Okay, so this is the cash flow without the interest, private lending interest. And now we're going to do the same calculation over here. But now what we're doing is we're saying it's going to be the 187, divide that by 12. That's $15 a month. Okay, that totally sucks. Like, there's so many other things that I could do with my time to get $15 a month. That doesn't include the headache. Okay, so this particular strategy may not work because this cost of borrowing the 20,000 is so high, right? Now, if I was to borrow it from my line of credit, so I think maybe it's 5 or 6%. So I'm just going to put 6% here. Let's see here. So yeah, because it's usually prime plus 1 or 2%. So let's just say it's 6%. So okay, maybe now it's a little bit more worthwhile, right? But it means that I have to have a line of credit that is at 6% and has, 20,000 K of space. And then that's where it would start like being borderline okay, right? So if I don't have this HELOC, then the question really is, if the will I make more than the interest that I have to pay every single year? If I do make more interest from the property, then I don't need to bring in a money partner to cover the interest. But if my interest is so high that we really don't make enough to cover that interest cost, then it makes sense to bring in a money partner. Okay, so at 6%, that's where it's sort of like maybe I could still do this on my own. But the minute you go to like 10%, okay, then you may want to consider bringing in a money partner. If you have to borrow at 13 or 14%, like here now, we're at a negative cash flow. Definitely at this, in this situation, it does not make sense to fund it on your own. It's better to bring in a money partner, give up, 25 to 30%, or, even 50%, depending on how you structure it. It might make sense to bring in that partner so that you can make these opportunities happen. Okay, so now the interesting thing is that, there's always that constant debate about doing multifamily versus single family. And yes, there's so many benefits of doing multifamily. Like, I've got a lot of multifamilies as well, but this is a different strategy. This 100K to 1 million strategy is different because now we're not looking for one property at 1 million. We're looking at multiple properties at 1 million. Okay. So the expense ratios would be very different. And the amount of money, even though it's at the end of the day, you're going to have 200,000 going in, it's a different strategy altogether. So I wouldn't really compare the 100K to 1 million strategy to doing a multifamily, right? Like it's a different asset class. Okay, so I'm gonna leave it at that because I'm a big believer in multifamily, but one of the reasons why I'm looking at doing this 100K to 1 million is because the entry point is significantly less and you could scale it as you grow, right? As opposed to saying, okay, well, I definitely have to bring in money partners and and then there's all this legalities and partnerships and stuff like that with it, right? Okay. The other thing to think about is if you have to borrow interest, a high interest loan on this, how quickly can you pay it back so that you don't have this high interest loan, right? So it's this second point here is how quickly can the down payment be paid back? Because once you pay the down payment, okay, then you won't have this high interest loan anymore. Okay, so the way to calculate this interest was I just took our down payment times whatever this interest rate is, and it's going to be interest only. So if the interest only is at 13%, okay, the net income on this is negative. We would never have enough money to pay it back. So at this point, it doesn't make sense. But now let's just say it's at 6%. So we would net about $1,000. Okay. So that means that it would take us, so where is this here? So if I go 20,000 divided by my $1,000, it's going to take us about 20 months to pay this off, right? Time to pay off your DP. Okay, so that's in months. So that's 20 months to pay off. Okay, that means there's no cash flow for anybody for 2 years. Okay, which really sucks. Okay, so that's definitely something to think about. Okay, and which is why it might make sense to bring in a money partner. Now, the argument there is, okay, well, Hung, just suck it up for 2 years, because after that, once you pay it off, well, then now you've got no money in the game and you don't have to give away 25 to 30% equity. Okay, so let's calculate what that would look like here. So if I go here and I say, let's see here, let's go that out. Okay, so let's just say this is 25%. So this is your equity that you're giveaway, right? So equity giveaway. Okay, so what does that actually mean when it comes to equity giveaway? So really it's your 25% and it's whatever your total assets are going to be at the end of the day, right? Because that's assuming that you're going to have to, pay down the mortgage and carry this property all the way through until the very end or until you sell. Okay. So now we're not including appreciation here. Okay. So let's just say that it stays at 1 million and there's no appreciation, there's no mortgage pay down, nothing like that. It's just the million. Oh, sorry. So there would have to be mortgage pay down because we're assuming that we're paying down the whole million. Okay. So let's assume, okay, so let's see, did I do that calculation formula right? Let me see, where is it? Okay, so based on that 1 million, okay, which is at D5, or in this case, it was 100,000 because we reduced it to 1 unit. Okay, so we got that number there. So 100,000 times my 25%. That's what I'm giving away. Okay, so basically I'm giving away $25,000 to give away 25%. That is just based on the equity of this 100,000 being paid out. Okay. So that doesn't seem like a whole lot when you think, oh my God. So like as a money person coming in, that doesn't seem like a whole lot because, hey, I'm putting in 20,000, but I'm only making 25,000 from this one property. Okay. And then it's going to take us 25 years to pay that off. Okay. So in that mindset, thought process, it doesn't make sense because it's just based on this. Okay. But then there's cash flow and then there's going to be appreciation. So that's the part that needs to come in here, right? So the return on invest, yeah, because, and then also too, because we don't have appreciation in here. Okay, so if we assume that there was a 3% appreciation and then we had the mortgage pay down already, which is that 1 million, okay, and then they get 25% of that. So that's, sorry, 100,000, so they would get 25%. The 3% is from appreciation, okay, and that is year over year over year. Okay, so is there a quick way to calculate what appreciation is over 25 years? So the way to think about that, okay, is I'm going to put this number here. So we're going to go back over here. Yeah, we're going to go that number. I'm going to make this bigger here. Okay. So if it's 3% appreciation, then the next year, at the end of the year, it's going to go up by 3%. So 3,000. And so the property value is going to be worth 100,000 plus 3,000. So 103. Okay, so this is going to be year one. Okay, so this is your starting point. So this is the base, your appreciation going up. So this is your appreciation, and then this is your end value. Okay, so now if we go into year two, okay, then it's going to start at the 103,000. And then basically this repeats again, right? So this is basically your normal compounding interest table. Okay, so then what we're going to do is we're going to go all the way to 25 years, okay, which is what we want to know. How much is this property going to be worth at the end of 25 years? Okay, so it's going to be worth $209,000. Okay, so now what we're going to do is we're going to pull this. Okay, so they get the 25% equity from the 100,000. The property at 3% appreciation is going to be worth this number here. Okay, and so I'm assuming that it's going to be going up every single year by this number. So I'm going to just make this more formula friendly here. So I'm just going to make that 3% equivalent to this. And then I'm just going to say this is going to equal that 3% every single year. Okay, so I'm going to go down. And so it doesn't change any of the numbers because it's just that 3%. But let's just say you're in an area and we see a 4% appreciation, then that number goes up to 266,000 on that $100,000 unit. Okay, so now we've got the mortgage pay down, we've got the appreciation, and we're saying for the cash flow, we're going to just say that it's $0. Okay, and why am I saying that $0? Do I need to say it's at $0? Let's see here. So we've got this cash flow per month, so we could just use that. Okay, so why don't we do that? So we're going to say that the cash flow over that time frame is 2,000 or whatever the number is going to be times the 25 years, which is the amount of years that we have the mortgage. Okay. Now, keep in mind that as we're paying down the mortgage, our cash flow will go up, okay, because now there's less going towards interest. But as the investors, we would look at refinancing when possible, pulling out the equity and then increasing that as much as possible. Okay. So I think it's realistic to say, okay, the cash flow is going to be 54,000 throughout the life based on this 2,000 something. Yeah, this 2,000 based on this one unit. Okay. So then we're going to go back and adjust it back up to 10 units to see what the numbers look like. Okay. So then in terms of an ROI for the investor coming in, so this appreciation number, we can adjust that. Okay. So based on an ROI, we're going to go with, this is the equity that they get plus the plus the appreciation. Okay, but they don't get the whole appreciation though. They get 25% of the appreciation. So let's go back and we're going to go the U3, which is the 25% appreciation. Okay, so 25% equity times, so the appreciation would be on the entire property. It's going to be worth 266,000. So it's going to be on the whole thing. Okay. And then we're going to plus the cash flow. And the cash flow is the same thing. They actually only get 25% of the cash flow. So we have to times it by this 25%. Okay. So now that should give us their total profit at the end of the ROI, sorry, at the end of the 25 years. So this is ROI for for the for the whole length, right? For the whole time. So that means now just the ROI for 1 year, ROI per year. If you were to break it down saying, okay, at the end of the 25 years, if we were to sell it or refinance or something like that, what is the actual ROI? So they had made 105,000 and they, oh, hold on, let me see here. So did I do this one right? Okay, so here is the total ROI, but then we need to divide it by the amount of money that they put in. Oh no, hold on. So this is the ROI in cash that they would see. Okay. So now let's go and do, I'm going to add in another column here because now I want to know. So this is how much money they would have made at the time divided by the initial cash that they put in, 20,000. Okay. So they would have made, and I'm going to put a percentage here, 527%. Okay, now that sounds really impressive, but keep in mind that it's for 25 years. So now we take that 25, the 527% divided by 25 years, and let's see what number per year. No, I didn't do that. Okay, so it's Y something, yeah, the Y divided by the 25 years, that's 21%. Okay, so I hope you followed me, okay, on that. Okay, so at the end of the 25 years, for the entire time, this investor who put in 20,000 is going to see 105 $1,000 in profit in the whole scheme of things. Okay. So that's equivalent. Okay. So basically I just took their 25% and I took a percentage of 25% across cash flow, mortgage pay down, and appreciation. Like those are the three cash flow areas within the camping strategy. Now, if there was any sort of forced appreciation, that would be recognized in this, but I'm running the assumption that there's no forced appreciation here. Okay, so keep that in mind. No, there's no forced appreciation. So the investor will make 105,000. And then because they invested 20,000, that works out to be about 527%. So basically I just take the 105,000 divided by the 20 that they put in. That gives me 527. Then I have to divide that by the number of years that were in operations. So that's 21%. So that's actually really good still. Okay, so now let's run the numbers with 10 units, okay, because that's my thought process is, okay, let's see if we can scale this up to 10 units to make it worthwhile, right? So 10 units within like a 30-minute radius of a secondary market. Okay, so all the numbers should still be the same, like there's no adjustments in the formulas. Okay, so now where does this take us? Okay, now some of this is not working out here. Woo. Okay, so now let's see here. Okay, now I would have to go and check this because this is saying 210 percent, right? And I think that's because we're just multiplying it by 10 buildings, right? Or 10 units. And so now we're up to $1 million here. Oh, you know why? Because they only put 20% down. Okay, so why did that not adjust properly here? So we went 10. Yeah, see, this should have, oh, no, that's not right. Okay, yeah, see, so, oh, sorry, so it should be based on this total down payment, not this F number. Okay, so we need to go back and change the F's to an H. So do we have any F's here? So F, there we go. So we need to divide this by H. So the 1 million in ROI divided by H5. Yeah, see, so the ROI still works out to be the same whether we do 1 unit or 10 units, right? So 21% is still really good, but I would choose to do 10 units because then we have that scalability. We would potentially be able to reduce some of the expenses, maybe. Although now we've got 10 roofs, 10 furnaces, all the arguments against doing the strategy and going for single family. Okay. So this actually still makes really good sense to do something like this, which is the traditional BRRRR strategy, right? But now we're targeting something very specific, which is the 100K. So now in the second line here, you'll see that I have 200,000. Because the thought is, okay, well, crap, like what if we can't find properties at 100,000? Like, what if that puts us into like a really high crime area, and we don't want that, right? And we want easy to operate properties where we get really good high quality tenants in there. So let's just say we're able to find 200,000 properties, $200,000 properties. We get 5 of them. We're still at the 1 million. So now how does this look so that we carry the calculation all the way through? So now let's see how this number operates going through. Now, why does this change? Okay, so this here, we need to go to the sheet. So now this is pulling the appreciation from that. Would the appreciation still be the same? It would need to be the same if it was based on this one here. So what I'm going to do is I'm going to copy this sheet over. I'm going to create a copy and we're going to move it over. So we have this sheet here and this one I'm going to label as the 200K. So that way, if I'm making adjustments to the formulas for the 200K, I can make that adjustment. So this one here is going to be based on the $1 million from the 200K. Whoop, I need to undo that. Okay, so 200K here. Okay, so what I'm doing is my starting value is going to be based on the 200K total assets under management. And I'm going to make the 4%. Yeah, the 4% is still going to be based on that original 4%. So that's good. So then based on that, we can go back here now and calculate what the appreciation would be. The appreciation would be based on this 200,000 tab. And the appreciation is 2.6. Okay, so it's still the same because at this amount, we're running it at $1 million. So everything should be exactly the same. Okay, so then our cash flow is the same, ROI is the same. Okay, now let's go here and instead of 5, we're going to just run it at 1 and see where that takes us across the board here. So we're going to go here. So now our cash flow here, now this is based on the 6%, right? So this is assuming I have the line of credit and so forth that we could do that. So the ROI is still exactly the same. Now, if I go up to 13, okay, let's go to 10. Does that even make sense to do that? On 1 unit, the interest rate is 4,000. We're cash flowing. The time to pay off is significantly more, like 106 months. Does that make sense? So the ROI, the net, yeah, it's going to take forever to pay that off. But I don't know if this is right. Like that 2 numbers seems to be the same here. So H and R, yeah, the 35 and H is my down payment. Yeah. So even with this, it still makes sense. Like there's no way it doesn't make sense to try to do this on your own. Like even at 10% here, you definitely want to bring in a money partner to help you do this. Okay. And it makes sense to bring in a money partner because you're bringing in a money partner, you're giving them 21%, but then you don't have to have this huge, massive debt. So now this is 0 here, right? So now your cash flow is significantly higher. And so now you're able to reap that benefit. So you're giving away 25%, but you're also getting to profit a lot of it. Okay, so that is what I have for you on this calculation. So like I mentioned, if you are a little bit stuck on that, reach out and join the breakthrough analysis paralysis coaching. And if you have not signed up for the speed networking, I almost said speed dating. It's not speed dating at all. It is speed networking specifically for real estate and business owners. Okay, so come out to this event if you're able to. Okay, thank you very much, everybody, for watching. I do apologize. I went a little bit over time. Okay, have a wonderful week, everybody. Bye.